Let's get a check now. The top business news stories. France 34's business editor Kate Moody has joined me. Hi there, Kate.
Hi, Tom.
Let's begin with what's been a large jump in consumer prices in the United States. Tell us more.
Yeah, inflation soared to its highest level in over a decade in April. The consumer price index jumped 4.2% compared to a year earlier. That's the fastest pace since 2008. Prices rose 0.8% compared to the previous month. It is the second consecutive month of high inflation. The Federal Reserve has said it will not raise interest rates or reduce its monthly bond purchases in a move to calm inflation because it believes the numbers will settle closer to its 2% target within the coming months. Well, that inflation data piled more pressure on Wall Street. After taking a bit of a breather on Tuesday, the tech-heavy NASDAQ has tumbled once again. It's down over 2 percentage points this hour. The Dow Jones down over 500 points as it continues a slide that saw its worst session since February. The S&P 500 also slipping away from its recent records. Well, for some perspective on what all this means, we can cross to Christian Lawrence, senior market strategist at Rabobank in New York. Thanks for joining us this evening. Explain, if you will, the link between inflation and the market sell-off we've been seeing this week. Why are investors so anxious?
Well, thank you very much for having me. And really, I think the link comes down to interest rates. Tech companies in particular enjoy an environment of very low interest rates. And essentially, the stock market is concerned that rising inflation won't be transitory, as the Fed is suggesting at the moment. And in fact, the Fed may be forced to raise interest rates earlier than expected. And this is one of the main factors that's really driven that sell-off that we've seen in tech stocks over recent days.
Well, as you've alluded to there, the Federal Reserve doesn't seem too worried about that hot inflation. Some economists have suggested that the central bank should be. Where do you fall in that debate? Do you think this jump in inflation is a warning sign for the U.S. economy?
I do agree with the Fed that this is likely to prove transitory. Of course, there's been a lot of talk about base effects driving that year-on-year number. But as we've seen, it's really been a large month-on-month change as well. Now, that 0.8% was boosted by the largest increase in the cost of used cars seen since 1958, nearly a 10% increase there. But we are seeing more in the way of these cost push pressures driven by supply chain constraints, driven by rising commodity prices. But unless we see sustained wage growth, those inflationary pressures are likely to ease. And in fact, they can prove disinflationary further down the line because they eat into people's disposable income. That said, unfortunately, at the moment, if inflation were to be persistent or it were to be transitory, it would look pretty much the same as it does right now. So we won't know for sure until prices come down or if they keep heading higher. But I tend to agree with the Fed that we are likely to see inflation pressures come off as we move into next year.
Now, the past few days have shown some rather contradictory signs about the state of the economic recovery. American consumer spending is surging. We see inflation very high there, and the labor market not picking up as robustly as we'd expected.
Yeah, and the labour market is absolutely critical here. The Fed has a dual mandate for both full employment and the inflation target. And without a doubt, they are far more focused on the employment side of things. And that makes sense when you consider that we saw record low unemployment heading into COVID, and yet we still didn't see much in the way of wage inflation. I think that sent a signal to the Fed that essentially they need to be focused on getting as many people back to work as possible. And we don't necessarily need to worry about a wage spiral as a result. But in the short term anyway, of course, the amount of stimulus that we've seen from the government, or I probably should say fiscal relief from the government, has really made sure that households have held up relatively well over the last year, despite all those job losses. But as the economy reopens and as that fiscal support is pulled back, we do need to see a continued improvement in that labour market in order to see more wage growth, more economic growth, and for sustained inflation.
So a tricky balance for the Fed. Switching back to the markets, what do you see as the biggest risk for global stock markets in the days to come? Are we in for more volatility?
It's certainly interest rates, without a shadow of a doubt, and specifically US interest rates. When we look at emerging market countries, for example, very sensitive to US interest rates because of a high amount of dollar-denominated debt. So if we do see the interest rates in the US continue to rise, and that 10-year interest rate rose about 7 basis points today to 1.68. If we do see that continue, then we can see a little bit more of a sell-off in equities. But either way, one thing we do need to get used to going forward is much greater volatility, much bigger ranges that prices trade between, because there is so much uncertainty going forward. Whether it's the Fed, whether it's the market, whether it's economists, whether it's analysts, none of us know for sure how we're going to recover from this crisis, because essentially we had a crisis like we'd never seen before. So this is a recovery like we've never seen before. So I think uncertainty means we're going to have a lot more volatility going forward.
Christian Lawrence from Rabobank, New York. Thanks so much for joining us on France 24.
Thank you.
The EU's second highest court has ruled against a European Commission decision to seek 250 million euros in back taxes from Amazon. In 2017, Brussels had found the tech giant was given special tax treatment that amounted to illegal state aid in Luxembourg. Luke Schrago reports.
Amazon won't have to pay Luxembourg 250 million euros in back taxes. That's after the EU's General Court ruled that the EU Commission hadn't proven to the requisite legal standard there was an undue reduction of the tax burden of a European subsidiary of the Amazon Group. The case dated back to 2017, with the EU's official in charge of antitrust issues, Margrethe Vestager, seeking to clamp down on tax deals that amount to state aid. She accused Amazon of benefiting from an arrangement with Luxembourg, where its European operations are headquartered, one allowing it to avoid paying taxes on 3/4 of its earnings in the bloc. It's something Vestager has targeted for years, and she's forced Belgium, Ireland, Luxembourg and the Netherlands to change their practices of offering sweetheart tax deals to attract firms to their territory. However, pushing companies to shoulder their tax burdens proven harder, with a similar case against Apple going in the tech giant's favour last year. For experts, existing rules mean prosecutors' hands are often tied.
We need to take the current corporate tax system and throw it in the bin. The transfer pricing rules have completely failed. And there are negotiations going on looking at updating the corporate tax system, but unfortunately governments are not ambitious enough. We need a complete reform because these rules are clearly outdated.
That may be closer than previously thought. Washington recently embraced the idea of an international minimum tax on multinationals, with the Organization for Economic Cooperation and Development saying the world had never been so close to a deal on the issue.
Well, in a separate case, also at the European General Court, the French energy giant Engie lost its appeal on a similar ruling about its tax arrangements in Luxembourg. It may have to pay 120 million euros in back taxes. France is reportedly set to delay the EU's post-Brexit agreement on financial services in retaliation for an ongoing row with the UK about fishing rights. Bloomberg and Reuters say Paris is preparing to link the two issues. That dispute over fishing escalated last week as military ships were deployed to the Channel Island of Jersey amid protests by French fishermen. They say they're being blocked from licenses that would allow them to fish in British waters, as outlined in the Brexit trade deal. The French government spokesman has said that Brexit issues are all related, that they cannot be regarded separately. Of course, Tom, fishing was one of the main sticking points in those years of Brexit negotiations. And even though the trade deal has now been ratified on both sides, we can see it's still making waves.
OK, well, thank you very much indeed for bringing us up to speed on all of that. Kate Moody, our business editor. Thanks. I'll be back in a couple of minutes. Do stay with us here on France 24.
Thanks very